What is the futures market? Today, I want to help you understand one of the most important concepts in trading, the futures market. I know a lot of people hear that and immediately think, man, that sounds complicated. But don't worry, I'm going to break it down for you in the simplest, most practical way possible. By the end of this lesson, you'll know exactly what it is, how it works, and why it's powerful, and if you want to become a day trader, which I know you do. So let's start with the basics. What exactly is the futures market? The futures market is a digital marketplace where people buy and sell contracts, not the actual product. These contracts represent an agreement to buy or sell an asset at a set price in the future. Let me give you an example. Imagine you and I agreed that 1 month from now, I'll buy 1 ounce of gold from you for $2,000. No matter what happens to the price of gold next month, that's the deal. That agreement right there is what we call a futures contract. Originally, these contracts were created so producers and buyers could protect themselves from price changes. A farmer, for example, could lock in a selling price before harvest to avoid losing money if prices drop. But over time, traders and investors changed the game. They realized they could use this same system not just for protection, but to make money from price movements. Now, here's the key. In the futures market, you're not just trading physical products. You're not getting barrels of oil or bricks of gold. What you're trading is the value of the contract itself. And the value changes as the market moves. If you buy a gold futures contract expecting price to rise, and it does, your contract gains value and you can sell it for a profit. If price drops, you lose value. The beautiful part, you can make money, whether the market goes up or down, depending on how you position yourself. That's what makes the futures market so attractive. Flexibility, liquidity, and opportunity in both directions. And you can trade futures on just about anything. Commodities, stock indices, currencies, even crypto. But no matter what you trade, the logic is always the same. It's an agreement on a future price. In short, the future market is where traders exchange contracts that represents the right or the obligation to buy or sell an asset at a specific price in the future. It started as a protection tool for companies and producers, but today it's an opportunity for traders who know how to capitalize on market movements. If you understand this concept well, you're already ahead of most of the beginners out there. In the next chapter, we're going to break down how a futures contract is structured and what you need to know before taking your first trade. That's what I'm here for. Now that you understand what the future market is, let's take a step further. Let's talk about what kind of assets you can actually trade inside the market. This is key because once you understand the different types of assets, you can choose the one that fits your lifestyle, your time, and your personality as a trader. In the futures market, you're not just buying stocks directly or touching physical products. You're trading contracts. And those contracts are based on different types of assets. Let's go through the main categories so you can see where you fit best. Commodities, raw materials. This is where it all started. The oldest side of the futures market. We're talking about gold, silver, oil, natural gas, wheat, corn, coffee, real world goods. Originally, these contracts were used by companies to protect themselves from price changes. Today, traders like us use them to take advantage of volatility, like me. For example, if oil prices go up, the oil futures contract goes up too. If you saw that move coming, that's profit. But listen, commodities move hard. You got to respect your risk and you have to stay disciplined. This is where I come in. The stock index futures, now we take it a step further. The most popular category for modern traders is indices. Stock index futures. Now we step into the most popular category for modern traders, indices. These contracts represent the movement of the entire market. Groups of top companies. Some of the most traded ones are E-mini NASDAQ, which is NQ, the tech giants, my favorite. E-mini and S&P 500 ES, the 500 biggest companies in the US. Dow Jones, YM, and the Russell 2000 RTY also are very active. These are my personal favorites for intraday trading because they have crazy liquidity, constant movement, and low trading costs. They're perfect if you want to focus on consistency and clean setups. Currency futures. You can also trade futures on currency pairs like the euro dollar or the British pound dollar. Unlike Forex, you're not trading in a decentralized market. Here, everything goes through regulated exchanges. More transparency, less manipulation. These are great if you want to understand how global money flow really works. Bonds and interest rates. This category is most institutional. It includes US Treasury bonds and other fixed income products. These contracts reflect how the market expects interest rates and the economy to move. They're not as popular among beginners, but they're essential for advanced traders and funds. If you understand how interest rates move, you understand where big money is going. Cryptocurrencies, and finally, the new kid on the block, crypto futures. You cannot trade Bitcoin or Ethereum the same way you trade any other asset. You don't actually hold the coins, you're just speculating on price movement. Be careful. Crypto is highly volatile, so your risk management has to be on point. So to sum it up, in the futures market, you can trade commodities, stock indices, currency, bonds, cryptocurrencies. Each one has its own rhythm, risk, and the type of trade it attracts. Your job is to find the one that fits your mindset and lifestyle. Don't try to trade everything because that's not good. You have to master one and let that one become your weapon. Welcome to the next chapter. Right now, you're a professional trader and now you're ready to make money. No, I'm just kidding. By now, you already understand what the future market is and what assets you can trade. But before you even think about entering the market, there are a few key concepts you need to master completely. There are the basics that separate someone who's guessing from someone who's actually knows what they're doing. So today, we're going to break down 5 of them: contract, margin, tick, point value, and expiration. These are the foundation of everything. They determine how profits and losses are calculated and how you manage your risk as a trader. Contract. In futures, you're not buying a physical product, you're buying a contract. That contract represents an agreement to buy or sell an asset at a specific price on a future date. For example, 1E-mini NASDAQ, which is NQ, contract represents a fraction of the total NASDAQ 100 index. Each contract has specific characteristics defined by exchange, size, value, expiration date, and settlement type. In other words, the contract is your unit of trade. When you open a position, you're not buying the asset itself, you're buying that contract. Margin. Margin is the amount of money your broker requires to open a position. You don't need the full value of the contract, just a fraction of it, which acts as a collateral. For example, if a contract is worth $100,000, the broker might require $2,000 or $3,000 as a margin. That means with a small amount of capital, you can control a much larger position, and that's called leverage. It can multiply your profits, but it can also multiply your losses. That's why smart traders use it with respect and control. Tick. A tick is the smallest price movement a contract can make. Every asset has its own tick size. For example, in the E-mini NASDAQ NQ, one tick equals 0.25 points. That means price can only move in increments of 0.25, not 0.1, not 0.2. Understanding the tick size helps you measure how sensitive the price is and calculate your risk precisely. Point value. The point value tells you how much money each point of movement is worth in your contract. Let's stick with the NASDAQ example. If one tick of 0.25 points equals $5, that means one full point, 4 ticks, equals $20. So if the price moves 10 points in your favor, what do you think it is? $200 per contract. If it moves 10 points against you, you lose $200. Mastering this relationship between ticks, points, and dollar value is crucial for managing your risk before you even take a trade. Expiration. Every future contract has an expiration date. That means the agreement only lasts for a certain period of time. For example, let's use NASDAQ again. NASDAQ future contracts expire every quarter in March, June, September, and December. When a contract gets close to expiring, traders usually roll over to the next active contract, basically moving their position forward. If you don't roll over, your trade could close automatically when that contract expires. Knowing your contract's expiration helps you stay ahead and avoid surprises. So let's sum it up. The contract is what you trade. The margin is the money you put down as a guarantee. The tick is the smallest price move, and the point value tells you how much each move is worth. And the expiration tells you when your contract ends. Understanding these 5 concepts gives you clarity, control, and confidence. Because in the futures market, knowledge isn't power. Execution with understanding is. Today we're going to talk about 2 essential approaches in trading: technical analysis, me, and fundamental analysis, and how they both apply to the futures market. Understanding the difference between the 2 will help you define your style as a trader and make sense of why and how price actually moves. Let's start with fundamental analysis. Fundamental analysis is all about understanding why price moves. It's based on economic data and news events that can impact the market. Things like employment reports, interest rates, inflation, or production data. For example, when the Federal Reserve announces a rate hike, the US dollar usually strengthens, and that move can directly affect futures like gold or major stock indices. So to keep it simple, fundamental analysis answers the question like, why did price move? Now on the other side, we have technical analysis, my favorite. The approach focuses entirely on the chart and price action. The core idea is simple. Everything that matters is already reflected in the chart. News, emotions, institutional orders, all of it shows up in the price movement. With technicals, you study patterns, support and resistance zones, trends, and indicators to anticipate where the market might go next. In short, technical analysis answers like when and where could price move? That's when I come in. Now, in the futures market, your approach depends on your trading style. Short-term traders, like day traders and scalpers, usually rely more on technical analysis because they need to react quickly to price movement. Long-term or institutional traders often rely more on fundamentals because macroeconomic events can drive trends that last for weeks or even months. But here's the truth. The best traders combine both. They usually use fundamental analysis to understand the context and technical analysis to find precise entries and exits. That's how you move from guessing to executing with clarity. So to wrap it up, fundamental analysis explains why price moves, and technical analysis shows how and when it moves. And in the futures market, both work together to give you a complete picture. If you learn to balance the two, understanding the story behind the move while mastering how to time it, you trade with purpose, not emotion. I'll see you in the next chapter. Welcome to this chapter. In this lesson, we're going to talk about something every trader needs to understand: the different types of traders that exist depending on your style. Knowing this will help you identify which one fits your personality, your time, and your goals inside the futures market. Because at the end of the day, the best trading strategy is the one that actually fits you. In general, there are three main profiles: scalper, day trader, and swing trader. The difference between them comes down to how long they hold their trades and what kind of market movements they are looking to capture. All right, let's break it down. The scalper is me, the fastest type of trader. This is my favorite style of trading. My goal is to take advantage of the tiny market movements that happen in seconds or minutes. So me as a scalper, I might open and close dozens of trades in one single session, aiming for small but good consistent profits. For example, if a NASDAQ contract moves a few points in my favor, I'll close it immediately and move on to the next setup. This style requires laser focus, quick reflex, and absolute discipline. You're in, you're out fast. And yes, it also means more commissions because you're taking more trades throughout the day. In short, a scalper lives in the now. They enter, take the profit or the loss, and step out. Day trader. The day trader also operates within the same day, but at a slower, more deliberate pace than the scalper. They usually hold positions for a few minutes to a few hours, and they never leave trades open overnight. Their goal is to catch larger intraday trading moves, and often around the times of higher volatility, like the market open. A good day trader is patient and precise. They wait for their zones, they execute their plan, and they manage the trade all within the same day. This style is one of the most popular in futures because it offers steady movement, great control over risk, and time freedom. The swing trader. The swing trader takes a wider view of the market. They hold trades for several days or even weeks, aiming to capture bigger market swings or trends. Unlike scalpers or day traders, swing traders don't have to sit in front of the screen all day, but they do need more emotional control because price can go against them temporarily before hitting their target. So do you have the patience for that? Swing trading relies heavily on technical analysis and on understanding key levels on the 4-hour or daily chart. So let's wrap this up real quick. The scalper goes for quick, small moves, fast, in and out, just like me. The day trader focuses on the daily move, patient, discipline, and done by market close. The swing trader aims for bigger moves that they play out over days or weeks. There's no better style, only one that fits your rhythm and fits your style. So find the one that feels natural to you, you master it, and then make it yours. And then I'll show you the rest in the next chapter. Welcome to this chapter. Today we're going to talk about one of the most important pieces in futures day trading. You know what it is? The broker. Without a broker, you literally can't access the market. So understanding what they do and how to choose the right one is absolutely essential if you want to operate like a professional. So a futures broker is a middleman that connects you, the trader. Through the broker's platform, you can buy and sell contracts, access real-time prices, and manage your trades. Their main job is to execute your orders quickly and manage your margin, which is the capital you use as collateral when trading with leverage. Now, there are two main types of brokers you should know about. Introducing broker, IB, focuses on client service and support. They guide you, help you, set you up, and give you the hands-on connection. Futures Commission Merchant, FCM, is one that actually holds your funds and sends your trades directly to the exchange. In most cases, they work together. One gives you the platform and the service, while the other provides execution and fund management. When it comes to choosing a broker, here's what really matters: regulation and security. Your money needs to be protected with no shortcuts. Platform stability. Your broker's tech must be reliable, especially during high volatility. And commission and fees. Understanding your costs, but don't base your decision only on price. And of course, customer support. When things go wrong, and sometimes they do, you want real people who can actually help you. Because remember this, the cheapest broker isn't always the best one. You want one that's safe, solid, and aligns with how you trade. So in summary, your broker is the bridge between you and the futures market. They give you access, execute your orders, and protect your funds. Choosing the right broker is one of the first and the most important real things for a professional trader. It completely shapes your experience in this business. The goal isn't just to trade. The goal is to trade smart, secure, and with the right foundation. Again, welcome. So of course, this is Danny.supreme, and today I'm going to show you exactly what I use to destroy the markets, how this has helped me, and how this made my life easier as a trader, and how my students are learning too. So TradingView is basically the main platform that every single trader uses. If you don't have TradingView, it's kind of like you don't have your shoes. So you're going to be freestyling this with me. You're going to be hand in hand learning this. And once you learn this, you're going to be able to analyze how to navigate the market, basically everything you need to know. So you ready? Let's go and let's tear it up. So this right here, what you're looking at is called TradingView. This is the main platform here. So on the left side, there's a sell and buy button. This is where you're going to be either selling or buying, depending on where the chart goes, where NASDAQ goes, which is exactly what I trade. Let's look at the left. The left side over here are different type of tools. A lot of these tools I use myself. And of course, when you're learning how to trade, I'll be teaching you how to use these tools. These tools are really important because when you're using TradingView, you want your eyes to see exactly where you're entering and why. Here, you're going to be able to enter the market with a buy or sell, like I just explained. And here at the top left is where you can switch from indices, crypto, whatever you want. So for example, right now I have NASDAQ, which is exactly what I use. But let's see, for example, if I wanted to do Bitcoin. So as you can see, it's already there on the screen, but you could do BTC, USD, and you'll enter Bitcoin. Or let's say, for example, you want to do Ethereum, just like this. Ethereum, as you can see, and you can just type anything to use. But like I said, it's always very important that you use one stock. Mine is NASDAQ, okay? So it's very important. And as you can see over here, my TradingView looks a little different. I like to color my candles white because this is very important. Nobody's going to tell you this, but the candlesticks are white because they're selling candles, and white calms down my psychological thinking when it comes to it going down. I don't get nervous because red usually scares people, right? Red is like, but with the white candlesticks, it keeps my psychological mind very, very clear. These are candlesticks, of course. So these candlesticks tell you a different story. Later on, I'll be explaining to you how that works. But these candlesticks are actually real people. So think about it, guys. These candlesticks are people that are trading. Bunch of people are in here. Millionaires, retail traders like ourselves, and more. Okay? You can actually click on the right here and there's settings. And with settings, you can actually adjust it. So I like to go over here to canvas, and you see the background. I switch it to black. When it comes to trading, let's see over here, canvas. Okay, the text, I put it white so I could show the price over here on the right side. So this is the price of the stock itself. All right, and let's go to symbols. So symbols over here is the color of the candles. There's green on the left side, and then there's white that I changed it myself for selling. Okay. So that's what you'll be doing. But you can do whatever you would like, depending on your style, right? So this is important. So as you can see over here, what we're looking at is different time frames. We got the weekly over here, so I'm going to jump into the weekly. These weekly candles basically show you what's happening in the week, right? You want to see where is it going. Then you have the daily as well, the daily candles, what's happening in the day. Then you have the 4 hour, 1 hour, 30 minute, and so on and so forth. It goes all the way down to the 1 minute. Which, of course, the 1 minute and the 5 minute is where I enter, but we'll talk about that more specifically later on. Very, very, very important, okay? Of course, you have over here different indicators. This is my favorite. Now, I don't use a lot of indicators. I don't want you guys to fill your whole chart with indicators. When you're becoming a day trader, like myself, I'm going to teach you how to just use some indicators to give you an exact entry and how to make you feel comfortable with confluences, all right? Now, confluences is basically more confidence, right? So let's talk about the indicators and let's enter right now. So let's take a look over here. As you can see, I'm gonna be showing you today about indicators and what type of indicators are here, which is a bunch of them. Let's focus on the top. As you can see, there's a bunch of them here that you can actually look for. I don't know, it could be any type of indicator that you're looking for. It could be Bollinger Bands. I mean, I have a bunch of them over here, but of course, I really don't use indicators like that. Later on, I'll be teaching you which ones specifically work that will be able to help you out. Mentioning the left side over here, there are actually trend lines that you can use, that you can create your own trend lines, as you can see, just like that, okay? So this is used for seeing clearly, all right? So with the left side and the tools, you can also look for fib retracements. It could be a little bit of everything, but it all depends on your style of trading. Let's take a look at, I don't know, let's say over here you want to add text. So you can add text over here and put, I don't know, looking at cells. It's not going to text, but looking at cells. And you can just type that up top, all right? So you can actually remind yourself of anything. Let's say, for example, in the left side over here with these tools, if you want to use an arrow, big arrow over here to point or explain something or remind you of something. Another cool thing too with TradingView is you can do alerts. So alerts, like if I click over here on this plus sign and I put add alert on a certain price, right? Which will be like right here. Let's just say if I think that the price is going to go up, I can actually put an alert right here, and then I can press left and I can put on the message here, price, buy when price goes up, right? So check it out, buy when price goes up. The cool part is that this tool is going to ring and it's going to say, buy, price goes up. Therefore, it's a reminder for me to enter. So I sometimes like to use that. Let's focus again on the tools on the left side. So this is a ruler as well. Nice, beautiful ruler. I use that sometimes to measure like my points where it's going up. Let's see, for example, if I want to draw. Nice little brush. You can draw, circle it, say, oh man, I'm looking at this right here. It's really cool. I like TradingView, guys. I mean, if you can master this, I recommend it. I recommend it. Let's talk about brokers. Now, in the broker section over here, you can connect any type of broker. I like to use TradingView. For example, let's say if you have a prop firm, with a prop firm, you can connect the broker, right? Because I believe Take Profit, some of them use TradingView. So you can connect the broker in the platform, all right? Or you can use paper trading, for example. We'll learn about that later on, or different type of brokers over here. So here, you basically look for the broker that's best suited for you. So when we're talking about trade execution, the cool thing is that you can actually use a live account too. So as I explained over here, you see how there's TradingView and there's the broker here. Let's say, for example, if you did not want to use a prop firm, you just wanted to use your own money, you can actually get an account with TradingView, and then you could find it here and actually link it to TradingView. Then you can be able to execute a trade. Now we're going to get to the fun part. What I'm going to do right now is enter a paper trading account. So let's say, for example, if you want to just paper trade and you don't want to use a broker right now, you just want to learn, I'm going to click paper trading here, and I am going to create an account. Let's say, for example, I come over here and I say reset this account so I can make an imaginary amount. I'm going to make an imaginary amount right now of, let's say, $50,000, right? 1, 2, 3. And then, I don't know, I like usually to put 1 in 200, which is usually what prop firms use. And I'm going to reset it. Now I have a make-believe account of $50,000 and it's paper trading. Now, I'm going to minimize this here and I'm going to, I don't know, enter a random trade. Remember now, one contract equals $1 when it comes to MNQ. So I'm going to press buy. Now, as you can see, I'm in the trade right now, live. Now, if I want to place a stop loss, which is how you protect your money, let's say if you don't want to lose a certain amount, I don't know, let's say you don't want to lose 200 in a day. You just lower this down all the way over here. And the stop loss is one of the most important things that's going to protect you from losing your account. Right here, stop loss. I don't want to lose $206. Now I want to do my TP, which is where I think the market is going to go. And then I'm going to move this all the way up here. I don't know, let's say I want the market, or I believe the market is going to go halfway through here because you've learned with me. Now, I am assuming, you know, with the knowledge that I've learned, that we're going to continue up. Now, my loss is protected by $200, And then my goal is that it will, get to 564. Now the question is, Danny, how do I know I'm going to make 564? We're going to get to that later on. The most important thing is that you know how to navigate the platform. So I don't want you to get impatient and say, I want to learn really quick, because that's not how we're going to do things. I'm preparing you to use this platform in the most precise and professional way possible. So when we continue to learn, okay, you'll be in good hands, okay? So as you can see right here, the trade is up. Right now, it is not like a high time frame to trade. Right now, it's 11:42 a.m. So it's not really fast. It's not moving fast. But as you can see, you're in the trade and the platform is doing its job. All right, so I'm gonna make this a little bit exciting. I'm actually gonna show you my trade today. So let's tap in. I'm gonna show you guys exactly what I did today and what makes Supreme Elite, University the most advanced university there is. Now, the way that I'm gonna teach you guys is gonna be like a system that I'm going to make sure that you're a professional trader and that you're funded, okay? So stay put. Let me load this up. Let me quickly show you exactly what I did today and what I did. So today I took a beautiful trade making $940. Yes, that's how I trade. And we took a drop over here. So remember, I was showing you just now some trend lines, right? So the trend lines that I've been showing you, I just marked this area over here. This area is called a support, but this is also what's called a demand area. We'll learn that later on. This area here gave me confidence to enter. Now, when I seen 930 happen, let's switch to the 15-minute chart. I actually took a buy at the bottom right here. This bottom was around 9:45 a.m. Eastern time. And I knew that the buy was going to be very important because this area here gave me the signal. By me taking a buy with my students, they automatically were profitable. I was automatically profitable. And many of them are getting funded. Insane, guys. Don't worry. You're going to get there. Danny.supreme got you. Now that we're back in the TradingView platform, I'm going to show you the free versus the paid version. The free version basically doesn't let you do much. It lets you navigate some time frames, maybe like a 4-hour and like a 1 hour, but not the 5 or 1 minute. The paid version is usually 21 bucks a month, I do believe. Very, very cheap. And what that allows you to do is it allows you to enter real time and you're not delayed. For example, over here up top, you see here, it does not show a D. That means that I'm looking at real time data. Now, with the paid version, it gives you real time data. With the free, you're actually delayed by 10 minutes. That means that if you're entering a trade, you're going to be entering a trade either 10 minutes late, which is not good at all. So make sure you actually subscribe to the paid version of TradingView. And remember, I do not work with this company, but this is necessary for every single trader who wants to learn. Okay? So when you do actually get the paid version, there's going to be, I believe, a $14 monthly subscription. And then what you want to do is you actually want to go here, all right, and explore settings and billing. And what I got is in subscriptions here, I got what's called the CME Group E Mini. The CME Group E Mini gives you the rights to enter and use NASDAQ. So you want to make sure that you add the $7 CME Group subscription together with the $14. It's going to give you everything you need. Now that you learn everything about TradingView, I do want to explain one thing. It is very important that you start first with the free, navigate yourself, get used to it. And then after that, when you feel comfortable, you go ahead and get the paid version. Now that you got familiar how TradingView works, the next video I'm going to be explaining to you what indicators to use, how to use the indicators, and how to navigate it more precisely. So I'll see you on the next video. Get ready, get sharp, let's kill it. Welcome to this chapter. So today we're going to talk about two fundamental topics every future trader needs to understand: the types of contracts and leverage. Once you understand how both of these work, you'll be able to choose the right contract size for your account and manage your risk with precision. Like a professional, like me. Not just kidding. But you will be one soon. Types of contracts. In the futures market, there are 3 main contract sizes, each designed for different kinds of traders. Let's break them down. Standard contracts. These are the originals, the largest ones. They represent a high nominal value and require bigger margin. So they're mostly used by institutions of traders with larger accounts. For example, a full-size S&P 500 SP contract is worth about $250 per point. If the index is at 5,000 points, that contract's total value is 1,250,000. E-mini contracts. These are similar versions of the standard contract. It is the one that I use myself to trade with my students and get them funded. These are smaller versions of the standard contract. Same structure, just less size and less margin required. The E-mini S&P 500 ES is worth about $50 per point. For example, a full-size S&P 500 SP contract is worth about $250 per point. If the index is at 5,000 points, that contract's total value is $1,250,000. E-mini contracts. The E-mini S&P 500 ES is worth $50 per point. If the index is at 5,000 points, that's a nominal value of $250,000. Micro contracts. These are even smaller, and I use these myself. They're made for retail traders with smaller accounts. Now let me give you an example of how a micro contract works. Let's say, for example, we have the S&P 500 MES is worth $5 per point. At 5,000 points, that's a total value of $25,000. This rarity gives you a flexibility. You can adjust your position size and your risk based on your capital and experience level. That's how you grow smart, by scaling safely, not emotionally. And this is something that I teach, but you have to wait on the other side. Now let's talk about leverage. This is one of the most important things in trading. This is how it works. Leverage allows you to control a large position with only a fraction of its value. That's possible because something called margin, the minimum amount your broker requires to open a position. Let's give you an example. If a micro E-mini S&P 500 MES contract is worth $25,000, the margin might be only around, let's say, $1,000, depending on the broker. That means that you're trading with roughly 25-1 leverage. If the price moves 10 points in your favor, you make $50. If it moves 10 points against you, you lose $50. That's the power of leverage. It multiplies everything. Your profits, yes, but also your losses. So you got to be careful. That's why I always say leverage is a tool, not a shortcut. If used correctly, it helps you grow faster. If used carelessly, it could wipe your account. And I don't want you to get there. So that's why you have me. So to wrap it up, standard E-mini and micro contracts give you different levels of exposure depending on your account size. Leverage allows you to control more than what you have, but it demands discipline and respect. So if you master these two concepts, you have a solid foundation to trade with precision and scale responsibly in the futures market. This is where you stop trading randomly and start operating with structure and real discipline. I'll see you on the other side. Knowing which order type to use and when allows you to enter and exit precisely, controlling your risk and protect your profits. In the futures market, the basic order types every trader must master are market order, limit order, stop loss, and take profit. A market order executes your trade immediately at the best available price. It is used when you need to enter or exit quickly. For example, during a breakout or strong movement. The advantage is speed. This disadvantage is slippage. If the market moves fast, you may get a slightly worse price than expected. A limit order allows you to define the exact price at which you want to enter or exit. For example, if you want to buy the NASDAQ at 18,000 points, you place a limit order at that level. It will only be executed if the price reaches or improves that value. It gives you control over the price, although there is a risk that it won't execute if the market never touches that specific level. A stop order is activated only when the price crosses a specific level. It is used both to enter during breakouts and to exit a losing position. For example, a buy stop above the current price activates a buy if the market moves upward. A sell stop below the current price activates a sell if the market moves downward. A stop loss is an order designed to limit your losses automatically. If the market moves against you, the order triggers and closes your position. Let's give you an example. If you buy at 18,000 and stop loss is at 17,990, you will lose only 10 points. Using a stop loss is not optional. It is an essential protection tool and it will save you a lot of money. A take profit does the opposite. It closes your trade once a predefined profit level is reached. For example, if you buy at 18,000 and set a take profit at 18,020, you secure a 20-point gain. This allows you to automate exits, avoid overtrading, and maintain discipline. All right, let's summarize this together. A market order executes instantly. A limit order executes only at the price you define. And a stop order activates when breaking a specific level. And last but not least, The stop loss order protects your capital, which is extremely important. And take profit secures your profits, so make sure that's also put in place. Mastering these order types is essential to trade with precision, professionalism in the futures market. So guess what? I'll see you on the other side.